Good morning. This is Renee Hahn with William Raveis, and I am honored today to have Melissa Cohn, also from William Raveis, but another part of the business, and we'll talk about that. What people don't know, but I always like to show the authenticity. This is a take two for us because Melissa was kind enough to do a full interview with me, and then the technology tanked, and it gobbled up and ate our recordings. So but I find everything she's going to talk about so fascinating that I'm honored to get to hear it again, Melissa.
Thank you so much, Renee.
Well, Melissa, before we jump into the questions that I had for you, I'd love for you to do just a little bit of an introduction so that people can know a bit more about you.
Oh, well, thank you so much. So I've been a mortgage banker for 40 years. I cut my teeth when I graduated from college at Citibank, and soon thereafter went to work for a marketing and sales company for condominiums. In 1985, decided I could do it for myself and started the Manhattan Mortgage Company, which was the largest residential mortgage broker on the East Coast of the United States. I had my company for 30 years, and then unfortunately, due to Dodd-Frank, I was forced to sell due to changes in compliance and KYC from various banks. And I've worked a couple of different places and joined William Raveis Mortgage 2 years ago and moved down to Florida a year ago to head up all mortgage operations in the state of Florida. I've been a top ranked mortgage originator ever since they started getting the numbers together. Spent many years as the number 1 or 2 originator in the country when I had my own business, and now and been ranked in the top 100 for the past number of years. I was, because William Raveis Mortgage is headquartered in Connecticut, the number 2 originator in the state of Connecticut last year and in the top 100 across the entire country.
Great. So hopefully with that introduction, people get a real appreciation for the fact that when we're going to talk about mortgages today, you are an expert. I think, Melissa, if we took the time to dive into all of your credentials and awards, we could easily spend a half an hour because you have such impressive credentials. And William Raveis is lucky to have you amongst our family of businesses. And for those that don't know, William Raveis, the company, is a broad really book of businesses, including real estate, including an insurance business, including mortgages. And then they've done some partnerships with title as well recently. So it becomes your one-stop shop if that's something that you want to have. And certainly, you know, there's no obligation to use William Raveis for all of those. You can use Melissa in the mortgage business and not have a William Raveis real estate agent. You can use a William Raveis real estate agent and not have to do insurance. So they are independent. It doesn't commit you to anything, but I think William Raveis does a great job of hiring experts in their field of expertise and brings in some great players like Melissa. So Melissa, today we are going to talk about mortgages. And as you can imagine, with what I keep calling a fluid environment that we're in, where things are ever changing, and illustrating the quote that the only constant in life is change is so very true these last few years. Mortgages is certainly a hot topic and a topic of interest. And what I wanted to start out on, you know, everybody reads the headlines and sees, you know, Fed hikes and interest rates. And so I know the audiences are really wondering what's going on in the world of mortgages, number one. And number two, are there ways to borrow money to purchase properties that are still financially attractive to people? And so the first question is, you know, what advice do you have on how to make borrowing money in this current interest rate environment more affordable?
Well, I think that we have to look at what are your current needs in terms of the financing. One of my favorite expressions that I use far too often today is that when you buy a home, you marry the house, but you date the rate. Mortgage rates have gone up exponentially since the beginning of the year. We started the year with mortgage rates at 3%, and they're now hovering over 7%. And these are for fixed rate mortgages. But oftentimes now you can find a great opportunity to buy where it makes sense to buy and find a way to get the cheapest possible borrowing. And I really strongly recommend to people that they consider looking at adjustable rate options, especially the 5 and 7 year adjustables. You know, the Fed has been raising rates. They just raised rates again yesterday by another 0.75%. We'll raise rates again in December, but at some point, these Fed rate hikes will mute inflation, and they will mute inflation by harming employment, by harming the economy, dragging the economy into a recession. But at such time that we find that inflation has peaked, mortgage rates will have peaked and mortgage rates will come back down. And I think that if we listen to the Fed and to their comments yesterday, that they are hell-bent on making sure that they can bring inflation down to an acceptable level, obviously, hopefully back down to 2%, but I think we would be happy with it, even a 3% rate of inflation at this point. And as such, mortgage rates will follow suit and come back down. You know, many organizations, Mortgage Bankers Association, Fannie Mae, Freddie Mac, largest lenders in the country, believe that mortgage rates will be at least a full 2% lower by this time next year. So that means that if you're buying today, the goal is to find a mortgage that will give you the lowest possible payment to bridge the gap until you can refinance next year. And that's with an adjustable rate. You can also help to further reduce your monthly payment and make that home even more affordable by looking at an interest-only option, where you're not making any principal payments, but your monthly payment can be significantly lower with the interest-only option than it is with a traditional 30-year amortizing mortgage.
Yeah, and I had shared this in our first round of discussions. You know, I've always just, I don't know if it was just a bias I had always done 30-year fixed loans. And when I look back, I've never even come close to owning anything, even a fraction of that. So, you know, there's two pieces to that, right? The one that you raise, which is, look, do you use it as more of a holding pattern until you can acquire a fixed longer term mortgage rate at a more attractive rate? But the other one is be thinking critically about what are your future plans and how likely are you going to remain the owner of that home and for what period of time. That can sometimes draw that decision out as well. It's a great point.
So true, because the average tenure of home ownership is now, I think, between 8 and 11 years. And especially as prices have gone up over the course of the past few years, you know, people are buying more for their immediate needs than sort of I'm buying and going to be living in this home for the next 30 years. So an adjustable rate is a good option. If you think about it, an adjustable rate is really a fixed rate mortgage for the initial term of that rate lock. So if you take a 5-year adjustable or a 7-year adjustable, it walks, talks, and is a fixed rate for that first 5 or 7 years. And there's no risk that your rate or payment can change until after that initial rate period.
Yeah, no, that's perfect. And you're right. Even the interest only, we bought a second home last year, and to avoid some of the jumbo loan considerations, we did a HELOC for a part of it because I knew by the end of the year I'd have that paid off. And then I would just have my regular primary loan. So there's lots of creative things. And one of the things I waited till the end to say this about Melissa on my last recording, but I'll mention it here, is one of the things I love about Melissa is solutions oriented. So she knows she has a repertoire of tools to use. And she will creatively, within the confines of what is acceptable and legal and attractive, she will find solutions. If you can talk with her and help her understand what your goals and limitations are, she's a very good matchmaker of solutions to those. So creative thinking is so key, and being a problem solver, because I've found a lot of mortgage people, none of which I'll call out by name, as soon as anything gets a little bit more challenging or trickier, all of a sudden they're not near as enthusiastic about finding a solution because it wasn't one of their top 3 things that they lend on. So definitely take advantage of reaching out to Melissa to find out about what's available, what makes sense, both in the short and long term. And I'm confident she'll help you find those solutions. What I wanted to talk about next, Melissa, is, mortgages in every other place I've lived are a very common tool for which to utilize to purchase homes. And then we get into the Southwest Florida, in particular Naples area, where we tout that, upward of 80% of our contracts are done as cash deals. So one of the questions that often comes up is, if someone wants to or needs to leverage a mortgage for the purchase of their home, what can they do to make that offer more competitive when they're competing against cash offers that have less contingencies?
Well, I think the most important thing is to be properly pre-approved. One thing that William Raveis Mortgage offers that other companies don't is that we have what we call a certified pre-approval, meaning that your buyer will provide us with all of their income, their assets, their liability. We run their credit. We thoroughly underwrite the loan with an underwriter, and the loan is basically approved subject to there being a property and an appraisal. So with a certified pre-approval, your buyer has the confidence to go out and perhaps bid without a mortgage contingency, because the certified pre-approval basically states that once you have a contract and if you need to get an appraisal, you have that appraisal, you're ready to close, so that we're ready to go before they even sign a contract. And you can make that offer even stronger by providing, with the certified pre-approval, verification of that buyer's income, verification of their liquidity, put the proof behind the letter showing that this buyer is ready to go. They are as good as a cash buyer. Many people, I know that the large majority of people in the Naples area do make all cash offers and sign all cash contracts, but you be surprised at how many of them actually do end up taking financing. So being able to also, have the confidence to make a non-contingent offer makes you as good as a cash buyer.
Absolutely. I think very well said, because when you think about when sellers are looking at assessing deals, particularly if they have more than one, and even sometimes when they only have one and may pass on it because they don't think it's the right deal, they want clean, simple deals that they can trust are going to get to the closing table. And what I found is not every pre-approval letter is worth its same weight. I have found some pre-approval letters that candidly should have been called pre-qualification letters, because when I call the lender, they actually don't have proof of everything that they should have had to make a pre-approval. So I think having that qualified, underwritten approval, and then with an agent that can articulate that to the sellers, gives, peace of mind that if they move forward with your deal, the amount of things that could potentially go wrong to make the deal fall apart is much more minimal. So thank you for that. What I wanted to talk about, because you operate in this hybrid world, which I'll let you talk more about. What are some of the lending solutions that you had, and in particular, some of the more popular ones that you're finding?
So at William Raveis Mortgage, we are a hybrid lender in the sense that we are a mortgage bank where we actually approve loans, issue commitment letters in our name, and close in our name. And we also have a broad number of banks that we act as brokers for, meaning that we submit the application to that lender, they issue the commitment letter, and they close in their names. And that offers us, gives us a very robust toolbox, so to speak. The most popular products that we're finding today tend to be the adjustable rate loans. 5 and 7 year adjustable is the most popular. It's interesting because of the inverted yield curve that many banks have gotten rid of the 1 and the 3 year adjustables, because those rates would actually be higher than the 5 or the 7. And a lot of people are also considering interest-only loans, where the monthly payment is interest only. You're not making any amortization payments, but it can have a significant benefit in terms of a much lower monthly payment. The one caveat I have with that is that it's harder to get approved for an interest-only loan. So it's not an easy way out to getting loan approval, for the banks with the best rates. But it's certainly, if you qualify, an option to help you keep your monthly payment even lower. We also have, thanks to our portfolio and broker banks, a lot of sort of what we call non-QM lenders. And there are a lot of buyers that don't qualify the conventional manner, averaging income, 2 years tax returns, people who are newly self-employed, people perhaps who don't have perfect credit, people who are buying for investment, relying upon the investment income to qualify for the mortgage. We have the DSCR, which is a debt service coverage ratio loan, where we don't consider the buyer's income at all. And as long as the property that's being purchased, the rental income from that property can cover the monthly payment of the mortgage, the homeowners association, if there is one, real estate taxes and insurance, that there is no other income verification. You just qualify straight off the potential rent. We also, for self-employed people, have programs where we don't have to rely upon what they show as their taxable income, but we can use profit and loss statements. We can do bank statement loans. We can do asset depletion loans. So if you have a retired purchaser, or even someone who's not retired, who has lots of assets, but no real traditional income other than the interest and dividends and capital gains that they declare on their tax returns, that we can rely upon the level of their assets in order to get them approved for financing. And oftentimes the rates on these products can be super competitive, especially the asset-based loans. The DSCR and some of the non-conventional programs, those rates are higher than a conventional mortgage, but it's a way of getting you or your client into home ownership. And in a higher rate environment, real estate prices are not appreciating as fast as they were over the course of the past few years. And if you have the opportunity to buy at a great price, it's worth paying a little bit more on the mortgage for the next year, or perhaps even a little bit more, and then refinancing when interest rates go down. I mean, it can be a real win-win.
Well, that's a great point, because we've enjoyed, even if you take the real aggressive appreciation we experienced over the last, 6 to 12 months, even before that, we had a really good appreciation rate that in some cases can outpace even a slightly higher mortgage interest rate. So great point. Thank you, Melissa. Talk a little bit about, Melissa, because whether it's, a regular home that didn't have any damage, but maybe like the one I'm sitting at today, where this is a beautiful home, but it doesn't have a pool. It's in a community where people may want pools. So a buyer may be interested in adding something after closing. Or the other unfortunate scenario we have is where there are homes that are being sold with hurricane damage. Tell us a little bit about products that allow people to purchase not only the home, but have some financial lending available for improvements post-close.
Sure. So first of all, we talk about, damage from Hurricane Ian. We're happy to report that, FHA and the federal government do actually have some great programs for people who have suffered due to the hurricane. One of them is a 203H, which is a product if your home has been rendered unlivable, even if you just rented it and didn't even own it, that through the 203H program, you can borrow as much as 100% financing. And that can be coupled with what's called a 203K loan, where you have the ability to not only purchase the property, but that the lender will finance the costs of the renovation or remediation if the home is damaged. Or if you, for example, the house that you're sitting in right now, if they want to be able to add a pool, perhaps a new kitchen, perhaps a lot of, some people from the hurricane had a lot of landscaping damage, you need to replace the landscaping. So through these called Fannie Mae Home Style 203K loans, you have the ability to finance 97.5% in some cases of the cost of the land plus the cost of the improvements, up to the county loan limits, or through the Fannie Mae Home Style through the conforming limit, which today is $647,000. The good news is that Fannie and Freddie will be announcing new limits at the end of this month. They generally come out at around Thanksgiving time. And it's expected that the conforming limit could be as high as $715,000. So that really helps a lot of people. Sure. If you're buying a higher price property, we have banks that will allow you to buy a home that's been damaged by Ian as basically land value. And then we'll layer in construction financing on top of that. It's a little more complicated if it's a jumbo loan, because in order to close on the construction piece, you have to have the plans and you have to have an actual builder's contract. If it's a conforming loan and you're doing one of the Fannie Mae programs, you don't have to have any written contracts. You just have to have an estimate of the scope of the work and the cost of the work that you're going to be doing.
Good information. So, I certainly don't expect, because I don't even, and I work in real estate every day, know all the different options. And no one's expecting you to walk away from today's discussion being able to regurgitate even a fraction of what Melissa shared. But I hope what people realize from this discussion with you, Melissa, is there are options that you may not even be considering that are both still financially attractive to allow you to buy the home that you need or want right now, and B, that there's a lot of different options besides the one we're all very familiar with, which is the conventional 30-year loan. So the best thing I always recommend is talk to a qualified expert who knows mortgages, and they will do an intake with you to listen to what your circumstances and needs are, and then downsize to a appropriate list of options that they can go through and take you looking at both the cost and the considerations for those. So thank you, Melissa. What I wanted to round off our discussion with is for you to share a little bit about why someone would want to work with William Raveis Mortgage, and in particular, you and your team.
Well, thank you. I think, first of all, working with someone who's experienced and knowledgeable and has been in a higher rate environment is very important. We are dealing in a rate environment that we haven't seen in almost 20 years. Having been a banker for 40 years, when I first started in business, I was selling 1-year adjustables of 15%, and people were buying and people were taking mortgages. So I've been in any number of different rate environments, and I'm not terrified by the fact that rates are at 7%. It's part of my job is to educate the buyers and make them understand where we are relative to rates historically, where rates are likely to go, and make sure that they're really properly educated on the options, and not just scare someone by saying, oh my God, the rate's at 7, you just have to lock this in this minute. I also feel that we offer the ability to make sure that we are shopping in the best interest of the client. When you go to one bank, they have one set of products and they're going to try and sell you what they have to offer. I represent 70 different lenders. So it's my job to really understand who your client, the buyer is, and what's the best product for them, not the best product for me to make a commission. I've always been in a relationship business. I've run my life and my career with that I'm only as good as my last mortgage. So that it's, super important to me to make sure that every buyer gets the mortgage product that's best suited to them and not best in the best interest of the bank itself.
Sure, that's a great point. And as a quick follow-on question to that, not all, but there are many buyers that will pick up the phone and call more than one lender to try to understand who might be the best match for them. I certainly encourage people, don't only look at the finances, which are probably still the most important. I can also tell you, look at what that experience is going to look like. Who are you going to work with? Are you going to have the consistency all the way through? I've had some of my own personal lending experiences. In fact, one with the lake home, that was an absolute horrible experience. I did not use Melissa and her team. I actually used somebody out of Georgia that had done some marketing with me, and I wanted to try them myself before I recommended them to anybody else. And it was awful. It was awful. So it does make a difference who you work with. And one of the things I wanted to ask you as an add-on question, as someone's out having those discussions, Melissa, how can they make sure they're comparing apples to apples?
Well, there are basically 3 key points that you need to be able to compare. Obviously, everyone wants the best rate. 2, how long is that rate lock-in good for? If someone's quoting you a rate that's only a 15-day rate lock, you're not going to be able to make application and close within that 15-day period. While the traditional closing in Florida is 30 days, we have closings that are 45, 60, and some even longer for new construction. So make sure that you're being quoted a rate with a lock-in period that will be able to get you through the actual closing date. And then what are the closing costs? People can hide fees in terms of closing costs. Why is that processing fee so high? Why is your settlement fee so high? Why is there an application fee and a processing fee? Making sure that you're really getting an apples to apples comparison. There are a couple of other things too that people should be looking out for. As we get to the end of the year and hopefully into the beginning of next year, I believe that interest rates will start to come down. So ask someone, do you have a rate with a float down option? Meaning that if you can lock your rate in now and the rate drops between now and the time you close, can you take benefit of that lower rate? Two, if you're buying a condominium, you need to remember that not only do you as the buyer have to get approved, but the building has to get approved. And in order to get many of these loans, the banks require that the building be Fannie Mae or Freddie Mac warrantable, meaning that the building has the proper amount of reserves, it's in the budget, that there are no deferred maintenance, and a whole bunch of other issues.
Rental proportion, all of those factors.
Right. Is there an insurance claim now because of Ian? A lot of condominiums had their amenities destroyed, so there are a lot of insurance claims that are out. Is there any litigation in the building, which will come up now as a result, or there's always been litigation, in our litigious country, things that will render a building unwarrantable. The good news about some of the portfolio lenders that we represent is that we can finance these non-warrantable buildings. And we still have some banks that understand that it's the buyer that makes the monthly payment and the condominium itself does not. So making sure that you're getting quoted a loan that you can not only close on for yourself, but that will actually close with the building or the collateral that you're buying.
Yeah, no, perfectly said. One of the things I really respect about Melissa, and I contrast it to the experience I have had with my lake house. The reason that deal did not go well was that I had a mortgage salesperson who actually didn't know their product and told us one thing. And then we got to the closing table and realized that the loan we had signed up for was very different than what they had told. To which they apologized, but we're still paying for. And one of the things that is not a problem, Melissa, is because Melissa, you're not just a salesperson. You are a salesperson, but you're not just a salesperson out trying to push product. You actually know lending, you know the products. So when Melissa describes a loan to you that you're about to get into a long or short-term commitment on, she knows her information, and that is priceless, because I can tell you again that that was not my experience on at least one deal, and it makes a world of difference. So
it's also important right now, just because volume is down, people are anxious about getting business, and I think people unfortunately will make promises that they just cannot deliver upon. So if you see something that you think it's too good to be true, it's quite possible it's just that.
Yep. Well, thank you, Melissa. I appreciate your time, not just once, but twice today. If you've got any questions, Melissa, I forgot to ask you on the last one, so this is a good add. How can somebody find you and contact you?
Well, you can go on the Raveis.com website and you can look up mortgages and you can find me. You can Google me because I talk to people all the time. Or you can call Renee and ask her for my contact information.
Perfect. Well, thank you again for your time today. And hopefully this was helpful for people that are considering taking out a mortgage, because there are still benefits to it. There are benefits in tax write-offs. There are benefits in leveraging somebody else's money and allowing you to do something else with yours. So we appreciate the information today and your time.
Thank you so much, Renee.
Have a good day, everyone.